How are charitable remainder trust distributions taxed? Have you ever wondered how the distributions from a charitable remainder trust are taxed? This is an important topic in estate planning, and understanding it can help you make informed decisions. A charitable remainder trust, often referred to as a CRT, is a unique estate planning tool. It allows you to provide income to non-charitable beneficiaries for a set period, after which the remaining assets go to a designated charity. First, let's talk about the tax-exempt status of the CRT itself. Generally, the CRT does not pay income tax on its investment income. This includes any gains from selling appreciated assets held within the trust. This tax-exempt status means the trust can sell assets without immediate tax consequences, which can increase the overall value and income potential for beneficiaries. Now, what about the distributions to non-charitable beneficiaries? While the CRT itself is tax-exempt, the income payments made to these beneficiaries are taxable. The Internal Revenue Service requires these payments to be reported on Schedule K-1, which details the beneficiary's share of income, deductions, and credits from the trust. Distributions from a CRT are taxed in a specific order. First, they are considered to come from the trust's ordinary income, like interest or dividends. Beneficiaries must report these payments as ordinary income on their tax returns. After all ordinary income is distributed, remaining payments are treated as capital gains, which typically arise from selling trust assets. These are taxed at capital gains rates. Following that, if there are any distributions left, they are taxed as other income, which can include tax-exempt income or miscellaneous income. Finally, only after all income categories are fully distributed are payments considered a return of principal, which is not subject to income tax. When a charitable remainder trust is created, the donor can claim an immediate income tax charitable deduction. This deduction is based on the present value of the remainder interest that will eventually go to charity. The calculation considers factors like the trust, term, and IRS interest rates. This deduction helps offset the income tax on the distributions received. In practical terms, charitable remainder trusts can be a great way to convert highly appreciated assets into a lifetime income stream. They also help reduce income tax liability while benefiting charitable causes. Additionally, they can assist in managing estate taxes by removing assets from the taxable estate and providing a partial income tax deduction upfront. The income stream to beneficiaries can be structured in different ways. It can be a fixed annuity or a percentage of the trust's value, with annual payments ranging from 5% to 50%. Once the trust term ends, or after the death of the last income beneficiary, the remaining trust assets pass to the charitable beneficiaries, which can be public charities or private foundations. In summary, while the charitable remainder trust itself does not pay income tax, the distributions to non-charitable beneficiaries are taxable based on a specific order. Ordinary income first, then capital gains, followed by other income, and finally return of principal. This tax treatment, along with the upfront charitable deduction and the trust's tax-exempt status, makes charitable remainder trusts a useful tool for estate planning and estate tax management.